Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. Right, in today's video I'm gonna share with you 10 different stocks, okay, that are right now that have a wide moat. That means they have a competitive advantage. They are either fairly valued or undervalued at the moment. They pay dividends, okay, or they have paid the dividends over the last 10 years or more, okay, without a reduction. So every single year over the last 10 years or more, they have been increasing that dividend. They are expected to grow their earnings about 4% or more, all of them. Okay, so these are the companies I want to share with you today. So right now the market is again going up quite a bit. It's becoming difficult to find a really nice undervalued stocks. There are a few out there, okay, and that's why I put this video together, so at least in the next few weeks you can keep an eye on these companies if you are interested and do a little bit more research. As usual, I'm just going to give you the a overview of some of the metrics that you need to know, but obviously do your due diligence and do a little bit more research before you invest. And as always, I've said to you guys, I'm not a financial advisor. I'm just giving you just information for you to consider and then go away and do your own research. Okay, as you can see, the portfolio has not dropped. Okay, don't worry too much about that. It's basically 59,400 right now. I made a sell a couple of days ago. I've trimmed to one of the stocks that I own, so that's why there's 1,100 pounds right now for me to use, and that's the money that I will be putting back to work next week, starting early next week. So I trimmed to one of the stocks that I own, so we're still on the right track. It's right now, as you can see, we are 7,000 pounds up, or 13.75% up right now. So again, it's just becoming too much. I'm looking at the companies that I own. I'm like, what can I do? Which companies can I add to? And they're all gone in the green. Even the ones that were in the red before, now all of them in the green. The ones that are in the green has just gone up so much. So it's becoming difficult to find a undervalued stocks, but we'll do. So today's video, like I said to you guys, I'm going to share with these 10 companies. Like I said before, they have a wide economic moat. Okay, they are very valued or undervalued at the moment. They have been increasing their dividends 10 years or more, and they are expected to grow their earnings 4% or more every single year. So the first company we're going to look at is 3M. If you haven't actually subscribed to the channel yet, or you haven't checked out some of the videos that we've done, or you haven't actually liked the videos, please do that, because it really genuinely helps the channel. Okay, so 3M is an industrial company. Company sells loads of different products. I'm sure you've come across some of these brands before. So Command, for example, is one of the big ones. Nextcare, Post-it, Scotch. They have 4 different segments, okay, when it comes to their business model. Okay, they have safety and industrials. They have transportation and electronics. They have healthcare and consumer. And soon they will be splitting the company. So we'll see how that goes. But right now, as you can see here, they have almost a 4% dividend, 3.92% dividends. Okay, 5-year growth rate of 6%. Okay, payout ratio 60%, which is nice. And I changed the color. If the company is either dividend aristocrat or dividend king, I've changed the color. So dividend aristocrats have increased that dividend for 25 years or more. Dividend kings have increased that dividend for 50 years or more. Okay, for 50 or more. And as you can see, this company has increased their dividend for 63 years non-stop. Okay, safety is 75%, which is very nice. Profit margin almost 12%, and they have $4.3 billion of free cash flow. Now, one of the things when we talk about free cash flow, one of the reasons we love free cash flow is because it allows the company to pay us dividend, to pay their debt, to buy back shares, to acquire other companies, to put it back into the business, so just to grow the business. So that's what the good thing about having a free cash flow. The more, the better. 5-year revenue growth, okay, is basically 3% right now. In the last 5 years, they also increased their EPS about 4%. This is a very old company. This is 4%, 5% growth is actually basically all right for this type of business. Okay. Total returns for the last 10 years is 7.82%. Okay, so if you own this business, you will have got about 8% over the last 10 years for every single year, right? Growth estimates for the next 5 years are expected to be 5%, which is fairly enough, okay? And then Morningstar is saying right now is about 18% discounted. the price should be $183 per share, and they are currently trading, I think it's about $152, $151 per share right now. Okay, so it's got a bit of upside. The next company we're looking at is A.O. Smith. This is a company that we talked about before. This is based in the US, but they also have branches in other places in the UK and so on. They do these type of boilers. Okay, they are just basically is one of those companies that whose products you probably wouldn't notice because they are part of your home or whatever. And when if you only buying a boilers and so on, you will see. So they have a branch in the UK. This is the one I'm looking at now. They also have a branch in the US and so on. Right now, they're trading they have a dividends yield of 1.76, 17% 5-year growth rate, payout ratio is 34%, and they have increased their dividend 28 years. So that means they are dividend aristocrat. Safety 99%, so that's really nice to see. Profit margin, we're looking about 13%. 40. I normally look for 15%, but for this type of business that have been around, they're like a dinosaur. They've been around for generations. So 13% is actually decent. Free cash flow, we're looking about in the millions, so 424 million. That's enough to cover the dividends. And then their 5-year revenue growth is about almost 6%, 5.67%. And then 5-year and EPS growth is 10%, which is really nice. And then when you look at their total returns over the last 10 years is about 18%, which is really nice. And they are expecting, the Yahoo analysts are expecting the earnings to grow about 8% next 5 years, every single year for the next 5 years, okay, which is really nice. Morningstar is saying right now is about 9% discounted, and their price target is $69 per share. Right, so the next company we're looking at is Amgen. This is a pharmaceutical company. They've been around for generations. They have a dividend of 3.13%, 5-year growth rate of 12%, payout ratio of 41%, and they have increased these dividends for 10 years. So that's the reason I've included. So like I said before, these companies have increased their dividend 10 years or more. Safety 74%, profit margin 22%. Free cash flow right now stands at $8.3 billion, which is very nice. And 5-year revenue growth is 2.47. EPS is grown actually 0.08. I think this company is starting to right now actually grow their earnings and everything else. As you can see here, next 5 years, they're expecting about 8%, although it didn't actually grow much last couple of years. But we're expecting about 8% growth in the next 5 years. And total return in the last basically 10 years has been 13%, 13.5%. Morningstar is saying right now is fairly valued. Their price target is $260 per share. I use Morningstar, like I've always said to you guys, is because I feel like they are quite conservative when it comes to their valuation. So I like that. The next one is a company that we've talked about recently. It's Applied Materials. This is one of the semiconductor companies, the equipment side of things. And right now they have just less than 1% dividend yield. The 5-year growth rate is right now 19%, which is very, very nice. They're growing that dividend very nicely. Payout ratio only 13%, which is nice again. So that means they can increase it. Number of years dividend increases is basically 16 years. So they're heading towards that dividend aristocrat. Safety 86%. Profit margin of 27%. Because they're in the tech companies, they normally have a higher profit margins. Free cash flow, we're looking at about $5.2 billion. And the last 5 years, they increased, basically they grew their dividends, not dividends, they grew their revenue, okay, 16.33%, and then EPS about 33%, which is very high. And then last 10 years, 25% of total returns, which is really good. Next to basically 5 years, they're expecting 13.77% growth of earnings, and right now it's discounted 26%. Their price target is $142 per share. The next company we're looking at is ADP. This is one of the technology companies out there. They've been around for a long time. They deal with a lot with the payroll side of things. They have a dividend yield of 1.62%, 5-year growth rate of 13%, 58% of payout ratio, which is actually not bad for a company. This company is really old. It's one of the oldest companies out there when it comes to payroll. They monopolize that market. When you look at their dividend, 47% of basically they're 47 years of paying that dividend, or increasing that dividend if you like. So they are almost the dividend kings, so they head in that direction. Safety right now is 97%, 17.9% profit margin. Free cash flow right now $2.5 billion, and then 5-year revenue growth is right now 6%. 5-year and EPS growth is 12.7%, almost 13%. And the last 10 years you would have made about 17% of your money, basically as a total return. And then growth estimates for the next 5 years, they're expecting about almost 14.5%. And then fairly value right now, according to Morningstar, $228 per share. That's their target. The next company we're looking at is Microsoft. Is one of my holdings, one of my companies in my portfolio, and a company that I actually really like. Okay, technology 0.85. I wish they increase this in the next few years. They are increasing, to be honest with you, every single year. So just about 10% over the last 5 years, and payout ratio only 21%. They have increased this 16 years, so which is really nice. Safety is 99%, and one of the reasons that it's the case is because of this cash they have got. Okay, profit margin is 26%, and $65 billion of free cash flow, which is absolutely amazing. 5-year growth rate, 5-year revenue growth, we're looking at about 17%. EPS grew about 29%, and total return in the last 5-10 years has been about 26%. In terms of growth in the next 5 years, they're expecting the earnings to grow about 16% every single year, which is really nice. Right now it's discounted about 18%, $352 per share. That is the target. Okay, I'm going to talk about this in terms of Sharia compliant bit. Every single company I've actually talked about now, I will show you what it looks like when it comes to Sharia compliant side of it in a couple of minutes. So according to Zoya, I will show you exactly whether they are compliant or not, and so on. Starbucks right now is, what the company does, 2.22% dividend yield, 17%, and the 5-year growth rate of 17%, payout ratio 62%, which is quite high. I don't like that, but hopefully they can bring that down maybe next couple of years. Number of years of they have increased this dividend, it has been 11 years, and safety 67%. So that's actually safe. Okay, profit margin, we're looking at about 13%, and we're looking about $3 billion cash right now. There's a lot going on with this company, with the union and stuff like that right now. Okay, with China lockdowns and stuff like that. So that's probably why the stock's down quite a bit. Okay, 5-year revenue growth about almost 6%, above 6%, sorry. 5-year EPS growth, we're looking at about 13%. Total return in the last 10 years, we're looking at almost 16%. Okay, that should say percent, not that, whatever it is. Okay, so almost 16%. And then growth estimate in the next 5 years is about 8%, which is really nice. And right now they are actually discounted about 13%, and $100 is basically their target. Okay. Now, the next one is Nike, or Nike, whatever you want to call it. They have 1% dividend yield, 11% 5-year growth rate, 31% of payout ratio, and they have increased this dividend. They are dividend aristocrat, and they are heading dividend kings. I didn't even know they were dividend aristocrat, which is very interesting. 38 years. In fact, let me just double check this. Okay, let's go to where we're going to go is this company here, NKE. I want to double check because I don't remember seeing it as a dividend aristocrat. There we go, 38 years. Okay, that's interesting. All right, so safety 99%, profit margin almost 13%, free cash flow here $4 billion, $4.4 billion, which is really nice. And they have increased basically grew their dividend, the revenue 6.38% in the last 5 years. Same goes for almost 8.36% of EPS growth, which is really nice. And then when you look at that in total returns, if you had this company in your portfolio, you would have made about 18% return, total return every single year in the last 10 years. 12% growth in the next 5 years, that's the expectation. Right now, 14% discounted, $133 per share. I think that's where it was about 2021, but right now is actually discounted, which is really nice. This company has been basically priced in during COVID times, but now it's actually doing really well. Now, next one is J&J, another company that I own in my portfolio, 2.73 dividend yield, 5-year growth rate of 6%, payout ratio 43%, and then they have increased this dividend over 59 years basically right now, 99% dividend safety. The profit margin about 19%, free cash flow almost $20 billion, and they have increased their revenue 5% or more every single year in the last 5 years. And then same goes for EPS, and total return about 11%. In terms of growth next 5 years, they're expecting about 4%. Is fairly valued right now $167 per share. That's the expectation for this company. And the final company we're going to look at, Robot Technologies. Some people say this company is industrial, some people say it's technology. They do a lot of, basically they develop a lot of software for businesses to use. So they also work a lot on the industrial side of things. So that's probably why. Right now they have 0.56% dividend yield, 5-year growth rate about 13%, payout ratio 16%, number of years 29%. So right now they are dividend aristocrat. Safety 98%, profit margin almost 50%, which is really huge. 1.37% free cash flow. That's really good, and that covers the dividends and so on. 5-year revenue growth of 8%, almost 9%. EPS, we're looking about almost 11%. Total return in the last 10 years, we're looking at, this is definitely has to be a technology company, because actually they do create a lot of software. So that's probably why. The margins are quite nice, and the growth as well. Total return in the last 10 years, we're looking about 16%. Next 5 years, they're expecting about 9%, and right now it's basically 15% discounted, $510 per share. That's what they're expecting. Right, let's go on here and let me show you in terms of Sharia compliant. As you can see here, every single one of these companies Sharia compliant. 3M in terms of business is 100%. Okay, 23% when it comes to debt. So what I'll do is I'll just zoom in, and then you can just screenshot that if you're really interested. And that's it. Pause the video and have a look at that. I'm not going to go through the whole thing, but as you can see, it's Sharia compliant. But the one company that I want to talk about is Microsoft. Okay, 93% when it comes to business activity, and there's 5% questionable. So that's why on Zoya it will say questionable. But that 5% they said is something to do with advertisement. That advertisement comes through Bing or whatever it's called these days. That who uses Bing? Okay, and when you look at the revenue breakdown, Bing is just literally non-existent when it comes to that. So I don't know if Zoya has got it wrong, and I'm sure they have, because they've made quite a few mistakes recently. There's one company, I think it was the DLR, which is a REIT. Okay, right now if you check, it says it's actually Sharia compliant, but when you do this side, when you check the interest bearing debt and interest securities, it's actually 40%, or basically there has a 40% interest debt and interest. I think it was the note, it was just the debt, I think. Okay, so yeah, they do make mistakes, but 5% from Bing, I don't believe that. And when you look at their revenue, it's not there. So that's why I'm still comfortable holding this business. Okay, so yeah, that's my take on it. The rest of the companies that are Sharia compliant there. Starbucks is one of the other companies people have a question on, because they might sell pork and all that stuff. Again, when you look at their revenue, a lot of that, almost a 99% comes from basically the coffee that they sell, not the other products that they sell. Okay, but yeah, that's my take on these companies. I hope you enjoyed the video. If you have a wonderful day. Please make sure that you like the videos. Okay, it really genuinely helps the channel. Have a wonderful day. Assalamu Alaikum.